Hi, I'm Billy Keels, the host of the Going Long podcast. Every week, I'm going to be here interviewing the absolute best in the business as it relates to real asset investing, as well as real Main Street investors. We're going to be having conversations where you can listen in, and that's going to help you to continue on your path to education so that you feel much more comfortable as well as confident in investing long distance. So make sure that you go ahead and subscribe to the channel. Make sure that you're liking it as well, because that way you can get every single episode as soon as it comes out. And by the way, don't forget to leave today's episode a 5-star review. Let's go ahead and listen to today's conversation. Welcome to the Going Long podcast. We're back once again to continue to help to educate you so that you feel much more comfortable and confident investing beyond your backyard. I'm your host, Billy Keels. And you know what? If you've ever wanted to know what it was like to go from living in Silicon Valley to moving to the Big Apple so that you could find the diamonds in the rough, then guess what? You're going to love today's episode because today's conversation, the guest actually has not only identified, negotiated, and structured well over $100 million in multifamily real estate, he's also evaluated thousands of opportunities using proprietary underwriting models. He's also he's an author who's published a #1 best-selling book, which is around multifamily underwriting, which is called The Definitive Guide to Underwriting Multifamily Acquisitions. He is also the host of the Capital Spotlight podcast and the principal at Lone Star Capital. I want to welcome to the show, Rob Beardsley. Rob, welcome to the show, man. Beardsley.
Yeah, thanks for having me.
Welcome, man. I get distracted because I'm seeing where you are, man. And so anyone who's not like watching us, you need to get over to the video version of this and check out where Rob is today. So Rob Beardsley, want to talk to you, ask you a couple of questions. I always like to start things off. And the very first question, we're going to adapt it a little bit today. So I'm always interested in understanding where our guests live in the United States. So if you maybe want to tell us where you live in the US and then maybe talk to us about what we're seeing in the background.
Sure. So thanks again for having me. I live and work in New York City, and I'm currently in the U.S. Virgin Islands. So I figured I would do this podcast on the terrace with a nice view behind me and not get bit by too many bugs, hopefully. But yeah, it's great. I not really vacation, but just like, kind of like the purpose of this podcast, I have the freedom to come down here and spend time and set up kind of a workspace for me and work with a better view.
Man, I love that. Yeah. And the view is definitely awesome, man. So thanks for that. And then listen, what is the most positive thing that's happened in the last 24 hours, Rob?
The most positive thing is we transitioned from a house to this new Airbnb that's, right by the water. And so kind of getting settled into the new space and calling this home for the next week has been the most positive thing.
All right, man. Yeah, I guess I could understand why. So fantastic. Listen, I've mentioned a couple things in just some of the highlights. And one of the other things I do want to mention is that I know you've published well over 50 different articles around underwriting and deal structuring and things like that. So I think that's really important for our audience to know. But can you give us a little bit more about your backstory, maybe some of the decisions that you made to get to this point in your journey, please?
Absolutely. So, my real estate journey started all the way back in diapers. When I was a baby, my dad would bring me to his construction sites. And so I was around real estate from the very beginning and grew up in a family where both parents worked at home and ran a real estate brokerage firm from home in Silicon Valley. And so I was, soaking up all the real estate, really by chance, wasn't necessarily passionate about it or doing much, wasn't involved at a very young age directly. But, as I got older and my passion grew for investing, that's where I circled back, looked at the stock market, looked at other investment options, and really realized that real estate was just, far and away the best asset for me to be spending time not only investing, but working with. So circle back to that and, use the great platform that I had from my parents in terms of their relationships, their experience, and being able to give me that knowledge. I was able to launch my firm, Lone Star Capital, after getting some, few years of experience working with them.
Man, that's fantastic. And to be able to see it from the time you were in diapers pretty much and be able to take that in and then from there to be able to recognize, hey, listen, this is something that you want to be able to do. You have the foresight already to be able to say, listen, there's a lot of knowledge base, there's experience, as well as a network from your parents. So, which is a good thing to be able to get your good foot in the door and continue to grow and add a lot of value. So, you know, so this is like, we're really fortunate to have you on today, Rob, because you're really going to be the first person to help our entire audience understand more about some of the processes that I think are absolutely key to understanding where you want to place your capital, right? And place your time and your energy. And that's this whole concept of underwriting. And so I'd really love for you to help us understand exactly what is underwriting and why is it so important to be able to really understand this whole concept.
Yeah, absolutely. So underwriting at its core is really just the financial analysis of an investment opportunity, right? And you're factoring in the revenues, the expenses, the debt assumptions, and also the business plan in terms of, your renovation budget and your rent increases or expense reductions associated with that renovation plan. And all that gets rolled into, typically an underwriting model done in Excel or something like that. And it, all those inputs spit out a few key metrics that all investors make their decisions on, such as return on cost, IRR, cash on cash, just making sure that the investment fits their criteria. So that at a high level is underwriting. And I think the key for our listeners today is to understand why it's so important, like you said. And so what I'll explain is, as a real estate owner and operator, you not only have to make the right investment decision, you also have to operate the property well and, continue to asset manage it appropriately and actually effectuate the business plan. However, as a limited partner or a passive investor, all your work is done upfront. So you have a front-loaded, responsibility to vet the investment, vet the sponsor, and then make the investment. And then from there, you have minimal involvement and minimal responsibility. And so not only is underwriting extremely important from a sponsor perspective, but it's potentially even more important as an LP, because that's one of the few tools that you have, because after closing, you don't really have an active involvement. So that's one of the reasons why I wrote my book, The Definitive Guide to Underwriting, because I didn't just write it for, emerging sponsors in mind, but I also wrote it for limited partners, for passive investors to understand the concept and feel that it's, not some unreachable thing that is just for the experts, leave it up to them. No, this is something that you can absolutely do. And actually it's something that you must do, before making investment decisions.
So this is great. And I like the way that you are helping to orient this, which is really about not just any active or general partner, but really focusing on the limited partner, those that are enjoying what they do during the day, right? They have a day job, or maybe they have their own company. And at the same time, they want to make sure that their capital is always working in the way that they want it to work, right? Different parts of your portfolio are doing different things. You just mentioned a couple of things though, and maybe we'll focus it more on the limited partner in a syndication, right? And so you talked about vetting the sponsor and vetting the deal. So let's first start with vetting the sponsor. Talk to us about, imagine I've never done this. I just know that I have some capital around, and I've heard a lot about multifamily investing. And look, I've got this marketing offering memorandum. It looks fantastic, and I don't really know what to do from there. So what are some of the things that you've seen that are best practices for really vetting a sponsor?
Yeah, so vetting a sponsor could be a whole other podcast and a whole other expertise, but just the high level of vetting a sponsor is you want to understand their track record and their infrastructure. So you want to understand, have they bought a property like this before? And, what other experience can they speak to show that, they have the capabilities to execute on the proposed business plan. And then infrastructure goes along with that as well. If they're buying a property in a market that's brand new to them, what steps are they taking to ensure that they have the right, personnel and infrastructure to actually incorporate that new market into their portfolio? So understanding things like that is tremendously important. And so since we're talking about underwriting, how do you take more qualitative assumptions like sponsor quality and factor it into your underwriting? And that's tricky, but one thing I will say is, as an example, so, when we're talking about vetting a sponsor, we don't mean you have to invest with just the best sponsors in the world, the ones with the best track records and everything like that, because that obviously limits your options, and maybe their fees or their minimums are too high for you to be interested. So you need to factor it all in all together. So the way I look at it is, if you're investing with a sponsor that maybe is doing something that's new to them, or they're going into a new market, or they're just a new sponsor, period, you're going to want to see a fee structure that's in alignment with that. Similarly, if a sponsor's buying a deal that's really a lighter lift and not a big project that's going to consume 2 years of their life, well, then maybe they shouldn't get that really big fee and that really big carried interest, right? So you want to see the deal, the sponsor, and the business plan. Yeah, the business plan be in alignment with the fee structure.
Awesome. So alignment is super important. And just because you mentioned fee structure, like for some people, they maybe never heard of it. Can you maybe give us some ranges, what you may see, because you talked about some are lighter lifts or heavier lifts, and just to keep that in mind, so really people can understand exactly what kind of ranges are you talking about there.
Yeah. So the most standard structure is going to have an acquisition fee that's paid at closing, and it's typically a percentage of the purchase price, and that'll be 1% to 2%. That's a very normal range, which can be a big range when you're talking about, let's say, a $20 million deal, but that's still the range. And then there's typically an ongoing asset management fee, which is a percentage based on revenue. And that, again, is 1% to 2% as standard. And then you're typically going to see investors being offered a preferred return hurdle of anywhere from, I would say, 6 to 10%, which is a pretty wide range. And I think this is the lever that speaks to the alignment in terms of deal risk. For example, if I'm investing in a development deal, there's a lot of risk. I need a bigger hurdle to make sure things go well. Now, if I'm investing in a core plus opportunity where we're really just clipping a coupon and there's not much management involved, and the total return is only 8%, well, then I can't really argue for an 8 or 10% preferred return as an investor. So it might be a 6 or a 7. So that's the range there. Mm-hmm. And then lastly, above and beyond that hurdle rate, you're going to have a sponsor promote, which is compensation, which is performance compensation, where the sponsor is getting a piece of the profits. And that's anywhere from, I'd say, 20 to 30% above roughly an 8% hurdle rate. So that's the standard structure. And then beyond that, there are obviously many creative structures and a million ways you can make a deal happen. Mm-hmm. What I will say, though, 9 times out of 10, when the structure is getting creative, it's typically not to the investor's benefit. Sponsors, when they get creative, it's often because they're getting creative for their own benefit. Not always, but that's typically the case.
It's interesting. I was just talking to a couple of sponsors recently, and the whole goal was make sure that you keep it as simple as possible for anyone who is potentially going to invest, because as we both know, a confused mind usually does absolutely nothing. So that's a great point that you talk about there as it relates to kind of the different ranges on the fee. So thanks for sharing that as well, Rob. But also, one of the things you kind of alluded to it a little bit, and it's this concept that I always like to get out on the table. Because people throw out the term, you did not, but I know that you can help us to understand this concept. And is when you're talking about a return, there's this concept of a risk-adjusted return, right? And so maybe you could, because you just started talking about it a little bit, but maybe help people to understand, like, okay, are all 10% returns created equally or not?
Right. It's a very great topic, big passion of mine, which is talking about risk-adjusted returns, because unfortunately, especially when you're talking about more of the retail investor world and not the more institutional or sophisticated world, investors are in a way almost risk blind. And especially investors that don't invest in real estate as their day job or as a profession, they view this thing as, oh, it's just this private, illiquid real estate investment that I do on the side. And for me to want to make such an investment, take money out of the stock market where it's liquid, it makes sense, it's comfortable, I need a 15% return or I need a 20% return. And that stated return is agnostic of risk almost, right? And they might just look at, well, a multifamily investment is a risk of X, but really there's a million different levels of risk between multifamily deals, right? Depending on how they're leveraged, what the business plan is, and things like that. So it's absolutely critical to drill down and understand, where are you in the capital structure? and what is the actual deal level risk associated with the business plan. Are we doubling rents, having to kick everyone out and spend $2 million? Because that's a bigger risk than buying something that has great in-place cash flow and we're clipping a coupon. So risk-adjusted return is all about understanding the risk of the deal and then correlating it back to a return level. And so the way that we do that internally is we keep an updated matrix, and we have different X, Y, and Z, or X, Y axes that talk about the quality of the asset, quality of the location, and then the risk of the business plan. And then we have an associated return for each of those risks, we'll call it.
Wow. So that's phenomenal. And I appreciate you giving that as an example, right? Because depending on, and you talked about it before, the type of lift that's going to happen, like, is it a lighter lift or a heavier lift? That will definitely impact in terms of the potential risk associated with that particular project, which should be reflected then once again in the expected return on that project. So I appreciate you talking about that. There's these other two concepts as well that get thrown around a lot, but maybe people are afraid to ask. So guess what? I'm going to ask the question. You talk about two concepts. One is a sensitivity analysis, and the other is a stress test. So as it relates to underwriting, can you maybe talk to us about what those concepts are and why they would be important, especially going back to that passive investor potentially?
Absolutely. So sensitivity analyses are just basically varying different inputs and then seeing what the resultant outcomes are, not necessarily in a bad way like a stress test, right? That's what typically when you're stressing a downside scenario. But a sensitivity is, well, we think rent growth is going to be 2%. Well, what if we're wrong and it's 1? Or what if we're, what if we're wrong also and it's 3? And how does that affect our returns? And so sensitivity analyses can give you a good understanding of what inputs are sensitive to the return. So for example, like I mentioned, rent growth, for example, that plays a big part in return. So if you are banking on 3 or 4% rent growth, you'll be surprised to see how much your returns are cut if that rent growth doesn't materialize. Conversely, there are things that are less sensitive. Like the example I bring up a lot is CapEx. CapEx is a one-time expenditure, and depending on the size of the project, like a $10 million project, for example, if you have, let's just say let's say you under budgeted by $100,000 on your CapEx budget, that's unlikely to destroy your deal, right? And so that is less of a sensitive input. So you can get that more wrong, let's just say. So those are sensitivity analyses. To be honest, I think those are a little more flash and less actually helpful. So they're good to show. Investors like to see them, and you can see the whole chart, all the different levels of returns. And I think one takeaway for investors is, well, let me look at all the range of outcomes and what's the worst range of outcome on the sensitivity analysis, and can I live with that, right? So that's where it's helpful. But the stress test, in my opinion, is where the rubber really meets the road, and you can really see what the risk of the project is and does the project stand up to those risks. And so I'll just discuss two stress tests that are critically important and for two different scenarios. So number one, we'll discuss bridge loans. So bridge loans, they kind of ebb and flow in their popularity.
And sorry, just really quickly, because for maybe a lot of people, they're not familiar with what a bridge loan is. So if you could just give us a quick definition of what it is, what it's used for, and then give us the stress test example. Thanks.
Exactly. So a bridge loan is a shorter term loan, can range from, on the really short side, 6 months, and then more conventionally, a 36-month loan. So whereas in comparison to a permanent loan is typically 10 years, right? There's a big term difference. So a 36-month bridge loan is typically also higher leverage, because a bridge loan is going to, the lender is going to provide you the CapEx funds, and they're lending you based on pro forma, not on in-place income. Whereas a permanent lender who's making a 10-year bet on the property, they're just looking at in-place performance to make their lending decision. So bridge loan is riskier by nature because there's a transitional business plan, there's a shorter maturity, and there's typically a higher cost. So you might think, wow, well, bridge loans sound very unattractive. Why would anyone do that? So bridge loans are actually a great financing tool for the right deal. So for deals that truly do have upside and have a material CapEx component, right, where there's a lot of renovations, a bridge loan can be more capital efficient. Also, for deals that are below 90% occupancy, which meaning they are considered unstabilized, they simply do not qualify for permanent debt. And that's where a bridge loan becomes a necessity most of the time. So that's a bridge loan. And with a bridge loan, the biggest risk that we have is maturity risk. Because it's a 36-month term, we need to make sure we hit our business plan and get it right in those 36 months. So that way, when our loan is up, we actually have created enough value to refi, put a new permanent loan on the property that is greater than the existing loan. So that way we don't have a capital call or a forced sale situation, which can be unfavorable, right, for both scenarios. So the refinance or exit test is the key thing for a bridge loan. And so the way that we stress that is we look at, obviously, when you look at your pro forma, you're being optimistic and you're going to pass that exit test, right? If you're going in with a $10 million bridge loan, your exit loan is likely going to be $12 million, and you're going to project to return $2 million back to the partnership, which is fantastic. But now let's stress some assumptions, right? Let's stress the value of the property via a higher cap rate, or let's stress the interest rate on the new loan. Similarly, we can say, well, let's say we're off by $25 or $50 on our pro forma rents. That's going to hurt our NOI, which hurts our future value, which means we can only get a lesser loan. So all those factors can go together to stress your exit ability on that bridge loan. And so that's the number one stress test on a bridge loan.
Awesome. Wow. That is, so what you just shared with us, I'm going to recommend that everybody get a chance to kind of rewind or watch again, because that was like a mini masterclass. So, and that was really important, because as you look at your stress test, it's like you said, is that going to affect the way that you sleep at night, or is that going to show the viability that you're willing to, that you're willing to kind of go through to get to the, to get to the end. So that was really helpful. You also mentioned one other kind of key term that we hear a lot of before, and I'd love for you to help everyone understand what it is as well. You talked about the capital stack, and could you talk to us about kind of what that is and what the importance or the prioritization is for those people that are involved in the capital stack? Right.
So some people look at a capital stack from, top to bottom or bottom up, and we very much so are in the group that believes that capital stack is built from the bottom to up. So we think, the way that we think is the senior lender sits at the bottom with senior priority. And then everything above that becomes, higher risk and lesser in priority. So the person at the very top of the stack is last to get paid and is last to get paid out in a sale or any capital event. And so just generally speaking, the preference is to be lower in the stack, right? But, not all of us want to be lenders making 3%. So we'd have to take some capital structure risk. And, typically that's why real estate is leveraged. And so, equity is sitting behind debt, which levers your return. And so, generally speaking, we're comfortable with that. And we're okay with sitting in that higher position in the capital structure. Where things get interesting is in the middle, where, you have preferred equity structures, you have mezzanine debt. And, so there's priority of payments either in between the equity, or there's, additional lenders on top of the senior. And so for investors that are looking at a deal, they can't just say, well, the deal looks great. They're raising rents by $200. It's in a great location. This is great, because you need to look further and understand, well, where am I in the stack? Am I sitting subordinate to all these other people who are going to be paid first and I'm paid at the very end? And that doesn't mean it's a bad deal. It just means, going back to your point of risk adjusted, is that return worth the risk of being last to be paid? So it all goes back to that. But that's the importance of capital structure. And so, and that's where we've actually not pivoted, but we've added an additional strategy where we're actually making investments that vary where they sit in the capital structure. Sometimes when we really like a deal and we have full control, we'll invest in the common equity, which is typically the most at risk in the structure. But additionally, we are now making preferred equity investments where we're sitting first in line behind the senior loan. So we're first in line as far as equity is concerned to get paid. And that gets us a lot more comfortable with the, our returns versus the risk, given that preference.
Okay. And I think this is, what you're helping us to understand once again, Rob, is like, and I always like to think of the capital stack, and I look at it in a very similar way as you do, is the closer you are to the ground, the more solid and stable you are. And the higher up that you go, it's like a tree, right? The trunk is usually well rooted, and then the higher you go, it doesn't mean that on a rainy day or a sunny day or a windy day that things won't happen all over the place. But the closer you are to the ground, the more stable that you are. And you're also helping us to understand, as you talked about, the risk adjusted return piece, and just some of the different questions that an investor can be thinking about, right? To help them to be more informed when they're thinking about project A, B, or C, and really saying, okay, well, yeah, I understand the fundamentals, where the capital is coming from, where we actually sit. And you know what, am I willing to deal with where I am in the stack? Like you said, it's not right or wrong. It's just you're more informed to understand where you are. So that's really, really helpful. I would like for you to tell us a little bit about, and you can take your pick, because we talked a little bit about the definitive guide to underwriting multifamily acquisitions. Maybe help people understand, like we're talking about some of the concepts now, but I guess what else can people that are listening that want to find out more? I mean, what can they find in the pages of the book?
So in the book, quick intro about what is underwriting, why is it important, simple stuff like that. And then I just dive right into the whole main concept. And so the way I wrote the book is actually, I looked at my own underwriting model that I built from scratch. And I looked at every single input that I have in the model that I have to input for a deal that I'm underwriting. And I just wrote about every single input. And so it was almost like my table of contents was staring right at me, because it was just my spreadsheet. And so that's why I think this book is so unique, because there's nothing like it, where you get a step-by-step walkthrough of how we underwrite every single input. We don't gloss over any input. I mean, everything is taken care of. So if you're willing to sit there and read it line by line and follow along with the spreadsheet, you're gonna master it. You're gonna have no problem. And while at the same time it's highly specific in terms of following along with my model, it's also just general principles, and you're going to learn a lot. Generally, you don't have to download my model, which is totally free, by the way, but you don't have to ever use it, and you'll still get a ton from the book, because you'll learn the principles of underwriting. And as we've discussed in this podcast, after I've laid the foundation of going through an underwriting, I layer on top additional practices, such as defending your rent assumptions through rent comps, defending your sales assumptions through sales comps, and analyzing markets, analyzing partnership structures, and things like that.
And so this is a really step-by-step guide, which is fantastic. And I know we have limited time, but it'd be great to actually have you come back and talk to us more about things like partnership structures and things like that, because these are also really important concepts. So thanks for sharing that. And it sounds like for everyone, you understand how important this concept is. And Rob is really giving you kind of a glimpse into some of the things he's talked about. His free Excel spreadsheet that you can check out, and also not just get the detail, but you can most importantly take those principles away. So look, there's another thing I do want to ask you about, because you're in St. Thomas, and this is super cool. And as we talked about before, like one of the main premises of our community, our podcast, is really being able to live wherever you want and make sure that you have the lifestyle that you want to be able to live, and you feel comfortable and confident in doing that. And so just the fact that you're in St. Thomas today, I think is awesome. So help us understand, with Lone Star Capital, you are able to add value to your clients all over the place, and you can live kind of wherever you want. So maybe tell us a little bit about, was that by design? And if so, how did it all come about? Because you're living the life that we talk about here every day.
Right. Well, I definitely value freedom, and that is, I tell myself, if there was option A of making X but no freedom, or making half X but having freedom, I would take the half X, because that's how I value it. And so that's my value system. So absolutely have set up my business and looking to continue to grow the infrastructure such that I have that freedom. And for me and my responsibilities, if I'm not in the States, not able to visit one of our properties, or make a meeting or tour a property, whatever it is, I have to be able to rely on my team to do that. And so it doesn't mean you just get to fly around the world and not think about your business, right? I mean, I'm constantly working, but as I've heard a few times, entrepreneurs are free to work any 12 hours of the day they choose. So that's my mantra, and that's how we make it happen.
Okay. No, I absolutely love that. And I'm a big believer as well, right? I mean, you talk about infrastructure, you talk about team, and that is one of the things that also allows me to live in Europe and invest, at least as of today, exclusively back in the United States. So I love the fact that we're seeing here. And like I said, if you're listening to us, you really need, I know I said it earlier, but you need to come and check out where Rob is, because it's just simply awesome. I love that place. Let's see. So there are a number of different things we could continue to talk about. And I've already said, I'd love to have you back and have you talk about some of the other concepts like partnerships and things. But you know what, Rob, we get to the part of the show where we've got to get to the going long final three. But the thing is, I never ask you the going long final three unless you tell me that you're ready for me to ask you. So are you ready?
I'm ready.
All right, cool, Rob. So here we go. So you helped us understand where you live in the United States, and you know that I live here in Barcelona, Spain. And so I would love for you to tell us, what is your favorite European city, either that you visited or is still on your bucket list to visit?
So I've spent some time, a few months in London. So I'll just have to defer and say London. Love the place, made great friends. So definitely looking forward to getting back there. But still, so much of Europe to explore.
All right, fantastic. So yeah, London's an awesome city. So when you make it back to London, make sure you give me a call in advance, and we can you can come here and visit me in Barcelona, man. So the other thing, and so we've talked about this concept of learning lessons, and most very successful people like yourself typically only make one mistake in their entire career. Well, maybe not. So maybe a couple. But I guess the thing is if you can think of one kind of mistake or learning opportunity that you had, but more importantly, Rob, like what is the one lesson that you would pay forward to other people so that they may not make exactly the same mistake?
So I think a general lesson that hopefully you don't have to learn the hard way, but often that's just the way it works, is due diligence, right? And that's true with not just real estate, but anything in life. Do your homework, do your due diligence, because finding things, the earlier you find out about an issue, right, the less expensive it will be to fix, or the easier it will be to walk away earlier rather than later. And kind of a parallel is something my dad always used to say is time moves very slowly when you're not in contract. But then the day you go under contract, that's it. Time moves very quickly. So everything you can do to prepare yourself and do it in advance of that, will benefit you during that period. So I definitely think due diligence in terms of, your deals, your partners. And once you have made that decision, move very quickly. So due diligence slow, act quick.
All right. Due diligence slow, acting quickly, and getting the value out of it, out of the lesson. So fantastic. And then the last question I have for you, Rob, is what book? Now I know you love reading, and that's one of the things we talked about in the beginning, but what one book would you recommend to the Going Long audience today?
Well, we're talking about real estate, so I'll keep it to a real estate book, which I actually just referenced in my LinkedIn video that you showed me before we recorded, which is Investing in Real Estate Private Equity. I can't remember the real author's name, but he wrote it under a pseudonym, Sean Cook, but he's actually a chief investment officer for a prominent multifamily investment group. So, and that's just an extremely well done book that gives you awesome basics and even some advanced ideas and principles digestible for the passive investor. So that's just a fabulous book that I would hopefully one day be able to recreate in some way.
Okay, fantastic. So Investing in Real Estate Private Equity, Sean Cook is the pseudonym, and then we'll make sure to include that in the show notes. So, wow, man. So we started in Silicon Valley, started with diapers, talking about your parents, being able to get the great surroundings from the beginning, having your own natural curiosity, really focusing on where it was that you wanted to go. And then you started taking action and carving out your niche. And by being able to do that, you are helping people all around the globe. The fact that you are a published author, best-selling author, I think is fantastic. And you've done a phenomenal job of really helping the Going Long audience today understand the key importance of underwriting, whether you are a general partner, and also too, more importantly, for the passive investor. And so, I know that you've got a wealth of knowledge. You also are living the dream because you are doing exactly what we talk about here and being able to have that freedom geographically. And I'm sure that so many people have been inspired by this conversation, Rob, that they're thinking, oh my gosh, how do I get in touch with Rob? How can I find out more about underwriting? How can I find out more about what he's doing, his community, stuff like that? So can you please help us understand, Rob, what is the best way for the Going Long audience to get in touch with you and find out more about you and your world and your community?
The quickest way to reach out and learn more is to head over to robbeardsley.me. And on that website, you can get, you can download my free underwriting model package, obviously a link to the Amazon to buy the definitive guide to underwriting multifamily acquisitions book. And there's, a bunch more content. So happy to share and happy to, reach out to me directly through that website or rob@lonestarcapgroup.com.
All right. Awesome. rob@lonestarcapgroup.com or robbeardsley.me. And we'll include both of those in the show notes as well. And listen, Rob, I just want to thank you, man. This has been fantastic. You brought so much knowledge to us. You've shared by showing that you not only talk the talk, you walk the walk by joining us from St. Thomas today. So I just want to thank you for joining us and for sharing your knowledge with myself and the entire Going Long audience, man. Thank you.
Yeah, thank you very much for having me.
Okay, awesome. And for the Going Long audience, listen, once again, Rob he really brought it home. He's really helped and added so much value to you. And, we would both love to have what you think about today's show. We'd love to get your review, what it was that you liked, what you would love to hear more of. And Rob's made it really easy to reach out to him. So definitely leave us your reviews. If you want to make it a 5-star, we'll accept those as well. And make sure that you share this with at least 2 or 3 other friends, right? Because you're going to be the person that helps to bring a little bit more light into their life. And so want to, like I said, just do those things, share it with the community and let Rob and I know exactly what it was that you loved about today's episode. And I guess until the very next episode, I want to wish you a wonderful day and go out and make it a great day. And we'll see you on the next conversation. Thank you. Wow. Don't you love hearing from top-notch experts in the field? When I was getting started, I really wish that I would have had access to such experts. And even more, I wish they would have given me like a really simple list of things to follow so that I could have gotten to my goals much faster and been much happier even sooner. So that's why I've created for you the 7 things that you should avoid in order to be successful in long distance investing. And you can pick that up really easily by going to billykeels.com/7 things to avoid. And also, if you liked today's episode, don't forget to leave a 5-star review. I'm looking forward to seeing you on our very next episode, so go out and make it a great day.